right, good afternoon, everybody. I'm David Huff, CPA with DW Huff Consulting, bringing you the August 29th, 2025 edition of News from the Front Lines of Business. So here we are. Another week has passed by here. Football season's about to kick off, so I think everybody's excited about that. But with that in mind, I want to point out something as one of my 3 points this week, dealing with the way gambling losses are now going to be handled after the OBBBA Act. So yes, one big beautiful bill. We're going to call it OB3 for short. But the problem with it is that now when you have losses related to gambling, where in the prior law 100% of losses would be used to offset your earnings and whatever's left over would be subject to tax, now we're limited to 90%. So I'm using this example here from a Tax Foundation article that kind of last week went into a little bit more detail, but they use this example to kind of illustrate the point of Daniel Negreanu. So he's a World Series of Poker winner. So going back to his 25 numbers here, he cashed out. So his winnings 1.478 million. His buy-ins 1.297, so his net 147,649. So under the old rules, they kind of break it out how, assuming he's in the highest tax bracket because of other things he has going on, because the 147 by itself wouldn't get him there, but assuming he has other things happening in the year, that would have generated a tax liability under the old rules of $67,006. And his net take-home pay after paying his tax would have been $114. With the new rules here, though, the problem is that this tax liability now jumps up from $67,000 to $115,000, where he's only netting out $66,000 after it's all said and done. So it's pretty bad. And here's a table that breaks down a little bit further. So as you're kind of walking through it here, 1.478, that's the amount of the wagers to 1.297. So under this new rule, he, instead of deducting the whole 1.2, it's 1.167. That is his deduction. So the net winnings ends up being quite a bit higher. And here you can see kind of the breakdown, just like we talked about in the previous slide, and how that works out in this particular case. But then they go a little bit further to illustrate 2 other examples that are kind of common. One where a person just breaks even, or one where a person made a little bit of money. So in this case here, this player B has $1,050,000 of excess here. So, but as we follow it through, so in the case of player A, who just broke even, so he won $1 million, he bet $1 million, but now he only gets to deduct $900,000 of his buy-in wagers. So in a case here where he didn't really make any money from his gambling, at the end of the day, money in, money out, this guy has a tax liability based on the fact that only $100,000, that $100,000 that remains that wasn't really a winning, is subject to tax at the highest rate. So this guy has a $37,000 tax hit on no income, essentially. So that's pretty bad, and I suspect there's an unplanned consequence of this law here. And then look at the example where the guy in player B's situation, he won $50,000 when it was all said and done, but subject to that same limitation because he bet $1 million, so he's only having the ability to deduct $900,000. So his net winnings were $50,000 essentially, but based on these bad rules here, the old way would have cost him $18,500 in tax, but now this year he's got $55,500. So basically he's paying more in tax than he won because of the limitation on the wager deduction. So yeah, it's pretty bad. So this guy ended up going the wrong way with it based on the new rules, where he's given up more than he even won. So there is some talk in this article about a review of that and possibly a correction, but we'll see. And just be aware of it, because football season, DraftKings, FanDuel, all that stuff, people are gonna be wagering. So if taxes are a consideration, you might not want to win any bets, or might not even place any bets, because you're not getting a full deduction anyway. It's kind of a bad thing. All right, so another discussion we had this week with a client. So we got this tax deadline in play here. A lot going on, and a lot of times, we look at the stuff, and now we got to kind of pay the piper on these returns that are on extension, and conversations. So we're just using round numbers here, but discussion with a client is that, oh man, I got $100,000 of profit. I spent $100,000 on stuff in his business. Let's just say, how do I have taxable income when it's all said and done? So just to recap once again, I know we've been over this quite a bit, but a whole bunch of things can cause that situation. So first of all, expense versus capitalization. So sometimes you buy an asset, you can't take full advantage of those accelerated depreciation rules. You might need to take it over 5 years or 7 years or some other longer recovery period. So that's number one. Also, a lot of times when you have an expenditure, it can be a repair or a replacement, also referred to as a betterment of a structural component. That's different treatment too, where the $100,000 repair would be a deduction. If it is a betterment, that's a different rule. I'm going to talk about that a little bit in the next slide. And also passive activity rules. So if it was real estate and could have generated a loss, sometimes if you're not considered to be an active participant, the passive activity loss limitations can also hurt you. But a more common misinterpretation, so this is referring back to a tax advisor article. This is one of the AICPA's publications here. And it's a little bit old, but I think the point's still valid here. But they went back and took a look at capitalizing versus a deductible repair and some of the the rules there. So the article's out there if you want to take a look at it in more detail. But I go back to this example that comes up a lot of times, like a roof. So here we are in hurricane country. Sometimes a roof gets ripped off your home, and maybe you don't have insurance proceeds to cover it, whatever. But so restoring versus deductible repair. So this is something that can bite you. So the general rule here is that first of all, there is no bright line test. So this is definitely one of those facts and circumstance situations that we really don't like, but a lot of confusion. So I guess the basics. So a betterment. So just to talk about the difference in a repair and a betterment. So there's an example down here. So to summarize it, there's an example where this particular business had a roof. The roof consisted of shingles, this liner, and some other hardware. So it starts leaking. A roof guy goes up and takes a look at it, and it turned out that it wasn't like the shingles and the whole roof. It's just this one component, this liner. So in that scenario, replacing the liner, repair. But if you took it a different way and found out that it wasn't just the liner, it was the entire roof that needed to be replaced, now it's starting to look more like a betterment, because when you put that new roof on there, it's expected to last 20 or 30 years, some long period of time, whereas the roof that was initially on there might have been nearing the end of its useful life. So whether or not we're talking about the depreciation recapture rules, whatever, the fact is that putting a brand new complete roof on there is not the same as repair, even though it was leaking. So a lot of this article goes into a lot more details and nuances, but I'll just mention that to you as well. So sometimes what we think is a repair is not a repair; it's a betterment. So those are some examples of some things that can bite you when you spend a lot of money. So lots of traps out there when you're talking about capitalized versus expense. All right, so another discussion that's come up this week, the self-directed IRA. Just to compare and contrast real quick, so when we're talking about self-directed, we don't mean where you take your IRA, you go to Schwab, Fidelity, and you pick your own investments. When we're talking about the term self-directed, what we're really talking about is buying investments that are not regular Wall Street type investments. So no stocks, no bonds. This is more like you buy a rental property and you keep it in the IRA. So now taxable income and expenses. There's no perceivable effect on a tax return because it all stays inside of the IRA or Roth IRA, whatever of these self-directed type of accounts you may set up. So a little bit different, but there's a lot of opportunity there. So at this time of year, like I said, as we're dealing with these extensions and deadlines, and people who are owing money, and it's unpleasant surprises now. particularly with real estate. So if you have real estate that you intend to hold for a long time, a lot of times it's better to just hold it inside one of these self-directed structures. So if it's a Roth IRA at age 59 and a half, and if it's held to meet the holding period requirements, money coming out of that is completely tax-free. If it's a traditional or a 401k, there may be some tax upon the distributions, but those tax benefits on real estate. So we've talked a lot about how sometimes you have limitations because passive income and whatnot, and sometimes as good of an investment as real estate can be, sometimes it's not. So if you're gonna be holding for a while, self-directed type plans can make more sense. So one more thing to think about. So and there's other things besides real estate that can go into self-directed IRA. The rules are kind of complex. So if you have questions, let us know. All right, so deadlines coming up on us here. Like I mentioned before, the S Corps 9/15, partnerships 9/15, and that's all we're worrying about now. We know the extended 1040s are coming up soon, and lots of deadlines. All right, closing thoughts for the week. So it's like I mentioned earlier. This is August 29th. If you're from the New Orleans or St. Bernard area, you know that's the deadline, the remembrance of the Katrina event. Pretty bad stuff here. And just notice how I don't like to pay a lot of thought to it because I feel like I kind of moved on now, and that's been 20 years. But in our town, so St. Bernard Parish, where we're located, looking at this chart here with 70,000 plus of people of residents here, pre-storm. It dropped, obviously to a really low amount post-storm, and recovered over the years. But here we're looking at this 2024 number, and it's only up to 44,783, and so a lot of as you drive down the main thoroughfare of Judge Perez here, you see a lot of buildings that just didn't get rebuilt, a lot of vacant lands where the property was demolished and just never got reestablished. So the damage is definitely a real lasting thing, and who knows how many more years it could take to get back to that 70,000, 71,000 population number, possibly never. So anyway, stop thinking about that. Enjoy your weekend, enjoy your football, and we'll see you out here next week.